Today on Founders and Fortunes, I'm joined by Ben Cotton, a London-based capital markets operator with more than 30 years across hedge funds, sustainable finance, and private investing. Ben has raised over $1 billion in investor commitments, founded Earth Capital Partners, and chaired private sector input to the G8 Gleneagles Dialogue on Clean Finance. Today, he works with family offices through Seeker, a modern capital placement platform, and Ianua, a trust-based co-investment community connecting families around direct opportunities. Hey everybody, welcome back to Founders and Fortunes. Today I have Ben Cotton joining me. Ben, it's great to sit down together. Just to give some background, we first met in Zurich at the Guterman Family Office event for High Impulse, and that had a really interesting room with a lot of interesting people. And I really appreciated Ben's clear view on the European launch landscape, type of capital that supports companies operating in these strategic sectors. And I've been looking forward to expanding a little bit more on that conversation and learning more about your work at Seeker Capital and Aya Capital and the philosophy that kind of runs through both of them.
That's great, Ryan. It's great to be on. Thanks for taking the time to.
Thank you. My pleasure. And likewise. And when you think back to that event in Zurich back in October, what was your read on that room and what it represented for European strategic technology?
It's really interesting, Ryan. I think Guterman did a fantastic job of getting a really eclectic mix of investors into the room. I think that High Impulse did a great job of presenting their business case and the broader context of what they're trying to do. And I felt they were given space and time to develop a whole load of themes that might not have come out in a shorter meeting. And then one of the things that I really valued afterwards was walking around talking to people like you who had interesting perspectives. And there's a lot of different views in the room, a lot of very interesting people. And I think they did a great job to get that sort of diversity into a room.
Agreed. And it's at least here in the States, the type of, maybe it's everywhere, but like family office conference, it's, it's really more a bunch of several different companies all trying to sell, and then a bunch of service providers. But this, I feel like, had such great purpose. And of course, the interest and exciting work that High Impulse is doing, did a good job there as well. And actually, I'll jump right into it. I really want to start and learn more about you today. What early, before we get into your current work, what early experiences shaped the lens that you bring into the world of capital and family office and long-term strategy?
Well, I'm one of the luckiest guys in finance. I've done pretty much everything. I got a series of opportunities. I started actually on the stock exchange floor doing traded options back in the 1980s, and then moved onto a desk doing more structured derivative stuff for about 10 years at a bunch of places. And in those days, there was a huge cast of characters that was a lot less regulated and a lot less normalized. So you've got to see a lot of weird and wacky stuff, and you've got given opportunities that now I don't think many of the youngsters actually get those sorts of opportunities. So I then moved to Societe Generale from Merrill Lynch in the mid-1990s. And again, it was a phenomenal opportunity to get into a whole bunch of different business streams. So there was a bunch of hedge fund work, a bunch of private wealth work, dealt with a bunch of family offices on transactions. We did funding for corporates. Basically, it was running a large chunk of the bank's business with financial institutions. And one minute you'd be building Fidelity's London headquarters. And the next minute you'd be pitching clearing and custody. And then 2 weeks later, you're creating the Sharia fund of hedge fund products. So it gave me the opportunity to stick my nose into just about everything out there. And the bank was brilliant about it. We made them a lot of money doing it. And we got a huge number of salespeople into a better position with the products that they were selling to clients. It was much more targeted and focused. But it was a lot of fun. And I had an absolutely brilliant boss who encouraged people to work on a new approach that wasn't necessarily natural to them. So I got really lucky then. And then I left them in 2005 and joined one of my clients, which was Man Group, which was the first really large publicly listed hedge fund company. And it was run by one of the loveliest guys that I've ever worked with, infinitely talented guy who ran this business and turned it into a powerhouse of the hedge fund industry in Europe. It's called the godfather of hedge funds in Europe. So I worked with him. We did a whole ton of stuff. We took the first FTSE 100 company carbon neutral. We built a massive green investment business long before anyone else was doing it. And he was massively supportive. He had this brilliant view of how transactions and businesses could grow. And again, it was a real privilege to be working with him. Unfortunately for me, he decided to retire at the peak of his powers, which meant that I span out a chunk of the business and we started doing a whole load of green investing, private equity infrastructure, clean tech, renewable energy investment. We pioneered a bunch of models for that. So, yeah, I'm a very lucky guy and very, very grateful for all the opportunities I've had. But each phase, I mean, right at the very beginning, actually, I was given a bunch of ultra high net worth clients to help them manage and structure their portfolios. For me, it's always been extremely interesting working with those guys. Pensions have their own rhythm and their own way of operating. But I think with families, you get a much higher degree of trust. And that trust can then be used to create really interesting outcomes. But people don't often know what they actually really want. So we've developed processes around questioning people and teasing out what really motivates their approach to investing and to philanthropy. And I love that bit of the game. It's great.
And so very interesting. And yeah, luck is involved, but talent as well, right? You got to continue to make these people money, I guess, to stay in those opportunities. So, but if someone were to stop you, somebody who's not really in the industry, and they ask what exactly you do, how would you describe your work across Seeker and Aya and the projects you're working on today?
It's Ianua. Ianua is a multifamily office. In fact, it's not really a multifamily office. It's a community that brings together families and creates a safe, trust-based environment for discussions around investment. So it's more of a co-investment community than a family office. But essentially, what happens is that they've got a large bunch of family offices that are active in markets, and they bring them together around themes. They call them nodes. So they've got a fintech node. Just had a
Mm,
really successful event in New York where a bunch of families came in from North America, South America, and elsewhere, got together, discussed a bunch of deals that the families were working on, brought in co-investment around those deals, and really used the talent in the room to build investment outcomes rather than just relying on an investment bank to deliver something to you.
right. Well, that's really interesting. And there's different directions I want to go from that one. And congratulations on having the success. And I think we talked, and if I'm not mistaken, because we spoke a couple of weeks ago, maybe the earlier stages of what led to New York, unless it was something different entirely. But I wanted to hone in a little bit more on the what what does a well-designed transaction look like from your vantage point? What signals tell you that the structure is aligned with either what the family is looking for? You mentioned co-investors. Like, what's the science there from your point of view?
That is a really tricky question. I think a well-designed transaction is one that gets executed efficiently. So flippantly, I'm going to say a transaction with no lawyers involved would be a great start.
I hear that a lot.
But yeah,
Yeah, they know how to ruin a deal.
yeah, I'm sure it's not deliberate. But I think establishing what is needed on both sides, what vision drives the seller, what vision drives the buyer, and aligning that early on is really critical. I think too much product is shoved down people's throats. And what then happens is you get into due diligence or you get to investment committee or the family just sits down and talks about it. And they sort of feel like they've been pushed in a direction they didn't really want to go and nobody's listening to them. And I think I was saying, so I've got a couple of lovely colleagues that I work with here in Seeker and saying to one of them this morning, I think the best tool for a salesperson is his ears, not his mouth, his or her ears and mouth. Yes. Um, and I think what I enjoy about access to families is that trust-based thing, the business of being able to sit down, talk to them about what they really want from the deal, and investing that time before you get into structuring, before you get into valuation and stuff like that. What actually are you trying to achieve by doing this? Does it touch a bunch of important KPIs for you, children, grandchildren? What are the motives and objectives that you need to achieve from the deal? And I think far too many people go out with a briefcase and try and force a product in order to get their commission, which is great. I mean, we're all doing it to get paid, aren't we? But
Yeah, sure.
I think that the fun bit for me is that business of actually working through what are the motives here. And I actually think that that applies just as much to the seller. And this is why I like the high impulse product,
Mm,
because the team are really clear about what they're doing. They really know why they're out there on the street raising money. They are very passionate about it. They're all very passionate about rockets. You can
they
see
are.
that from what they've done right from the very early stage. But that passion doesn't overrule their ability to communicate what they're trying to achieve and to turn what they say they want to do into practical actions.
I really like that answer, and I like this idea of it seemed like the big role that you play is resolving misunderstandings really before they happen, because a lot of the time the founder or the seller is not, they will blow right past what you're trying to represent, which are the interests of the family office. And sometimes that, more often than not, or at least is built to last more than one generation or more than one deal. Can you speak a little bit more about that? Because I really like your opinion on working with families. I think founders lose that a lot when trying to either bring them in on a deal or trying to raise capital from families. There's a big disconnect, I think, between in aligning everyone's interests together.
Yeah, and I think that's why a lot of deals either get delayed indefinitely or fail, is because people just didn't take the time to listen to each other at the beginning. And, particularly with the family office, you talk to the principal, you get them excited about it, you have an hour of their time, you explain what the deal is, and it's really exciting. And oh, yeah, I really want to do that. But then if they've got a structured investment team behind them, those guys have got to execute the transaction. Their reward is not just the fact that they get paid by the principal. Their reward is often tied to performance of the portfolio. So if the principal shoves them into a deal that has no return, they're effectively handicapping their own ability to get paid. And so I
Mm,
think it's not just the principal that you need to get on side. I think in the old days when it was easier, we could basically get the principal to agree and force the juniors to do the deal, which made it a lot more fun and a lot easier if you're pushing the deal. But practically now, particularly post 2008, I think there's much more of a community approach to deals, which should mean due diligence is done better and that obvious landmines get avoided. But yeah, no, I think you're completely right. I think if people take the time at the beginning to align expectations and to try and understand what's motivating both partners, you've got a much higher success rate as the deal matures and you go through all the due diligence, the data room and the calls and the ODD, et cetera, et cetera. It's less likely that something that's a deal killer will pop up if that process has been followed.
hence the success of Ianua market. And something else on that, and kind of dig a little bit deeper. What have you learned about people and decision making through this career path that you've had, through the work that you've been doing? Because you've been privy to people with a lot of wealth. I mean, I'm sure you've seen a lot, right?
Yeah, I've been very lucky. I've had access to all sorts of amazing, interesting, wonderful people, and some not very nice ones as well. But my son will now be rolling his eyes if he's watching this. There's an old guy I met when I first started on the floor, first week on the stock exchange floor, and he came up to me and said, "Boy, how are you liking life in the city?" And I said, "Oh, Mr. Burgess, I'm really excited about it. It's fun." And he said, "You're addicted. You'll never leave." And he was right about that. But the other thing he said in the course of the conversation was, never confuse logic with investment. Now,
Mm.
that was nearly 40 years ago that he told me that. And I can guarantee you, Ryan, that I've repeated that story at least once every week for the last 40 years because too often people think they're behaving in a rational way and they're not. And so a lot of investments made in a way that people feel that they're being objective, but they're not. They're not being logical about what they do. They've got extraneous drivers that are pushing them to do something that really isn't core or fundamental to what they need to do. And that creates misery and distress because then expectations aren't aligned.
And I totally agree, and I love that. And so naturally, if it's not logic, then it's emotions driven, right? So what do you think makes the best deal makers? What type of cloth are they cut from that makes them successful if it's all kind of subjective anyway?
That is a really hard question to answer because there are a bunch of guys who spring to mind when you talk about great deal makers. And I think all of them had clarity, but the way they expressed that was very, very different from one person to the next. So some people would be quite brutal and quite direct about what they were trying to achieve. Other people quite circuitous. The guy that I mentioned at Man Group was often quite soft spoken and quite circumspect about why he wanted to do a deal. And then he'd call me and go, Ben, should we do this deal? And I go, no, for these reasons. He'd go, but no, but have you thought beyond? And he was brilliant at extracting value from the deals that he did. So what he didn't do was to screw every ounce of cash out of a deal. He left something that kept pride and motivation on the other side of the table after the deal closed.
Mm,
There was another very, very good guy that I met. He used to run the British version of General Electric, GEC, a guy called Lord Weinstock. And the one thing he said to me, I was a very junior analyst and I was very lucky and very, very excited to be able to meet this massively powerful industrialist. And he said to me, young man, always leave something for the next man. And that was
mm.
his secret of the deal. If you leave pride and dignity to the guy on the other side of the deal, and you therefore reinforce their motivation to continue doing what made them attractive to you in the first place, then you've got people who are supporting you in your goals. If you screw them and take away everything that had meaning for them, they're going to try and move off and go and do something else as fast as they can once they've collected the dollars.
And and that is fun. It basically don't be a pirate.
Oh, it's quite fun being a pirate, but it's not a sustainable living.
No, exactly. Well said. Very well said. To that point, how do you personally evaluate trust in a transaction? I mean, that's the capital that you work with, right? You have this investment group with families and you bring in different providers, different deals. What's your style of doing things, Ben? What have you found success in personally?
I found a lot of failure in being transparent and honest. Again, it
Mm,
comes back to that logical thing. My parents brought me up in a very simple, straightforward way. Is that if you put things on the table and you've got a great team around you, the team can cover for the things that you're rubbish at. And so,
mm.
um, if you're honest, my belief is that if you're honest and you approach a transaction with transparency, you're in a better position to optimize everybody's motivations in return from that transaction. But I think an awful lot of people don't work that way. And therefore, you end up having quite a lot of fairly painful, brutal experiences where you've gone on in with the expectation that everybody around the table is motivated by a good outcome. And some people don't have that same approach to a deal or that same approach to moral ethics. Um, and you can often end up in fairly horrible situations. So my feeling is that great deals are made from a position of transparency where both parties, even if their motivations or their way of approaching the deal execution is completely different, if people are prepared to sit down and grind out issues, then there's a much, much higher chance of the deal being successful post-close. Whereas if people have got hidden agendas and motivations, and I know this is a very unfashionable thing to say, but I think hidden agendas actually destroy value in the short, medium, and long.
Yeah, I don't think that's controversial at all. And I can kind of relate to that both from the upbringing side and then also getting burned a couple times. But in my experience, the people who burn others, they don't really last long in this business, I think, because it's about relationships and trust. And if you've been overly transparent or more early on in your career, how did you adapt to that? And I don't know if it sounds like you're still doing well. I don't know about those other people, right? But do you speak less? Like, we're dancing around specific incidents, but I'm trying to understand because it sounds like this is something maybe that you had to overcome, or did you insulate yourself, and like how did you adapt?
Didn't I still take the body blows? It's not a clever thing, but the point is that if you approach the deal with transparency and you've done your best, you can sleep at night. And that is one good thing. That one thing I can still do at the age of 60 is go to bed at night and sleep.
Certainly. Yeah, you get no disagreement from me there. Something that we did touch on this thread was the idea of deal. The longer we know, right, the longer it takes to get a deal done, the less likely it's going to be done. Whether it's drawn out from lawyers or whether it's delayed because of hidden intentions or people being unscrupulous. What do you think is, because this is something I struggle with, I've seen other people struggle with on the human side of capital. What is the role of patience in your work? What is the role of urgency? How do you delegate that? How do you save people's time while trying to execute, get things done?
Again, I think it's listening, not shouting at people. I think if you shout at people, they don't tell you what you need to know. Uh, I think the listening thing, it's expensive, and everybody's time seems to get more and more compressed as time passes. There seemed to be a lot more time to get deals done in the 80s, and yet we got them done faster, um, and with smaller teams. But people's time is intensive. There's an infinite amount of podcasts and books out there telling you how to manage your time. So I think people feel compelled to operate at speed. And I think you lose the granularity in the detail, which is ultimately, I think, what makes for long-term successful deals. And until you meet someone like the guy at Man Group who had a vision that managed to get things done quickly because he'd assessed what the motivations were, how to create motivation and value from the other parties, and how to deliver what his shareholders needed to deliver. He was absolutely the exception.
And I wanted to pivot a little bit too. This is something I don't know if we even had the chance to really discuss on our initial follow-up call after Zurich, but I work with a lot of families here in the US. I know Thomas Guterman, the Guterman family office, and a couple European family offices, not as many as I do here. But I've found that there's a big difference that I've seen between European family offices and then US family offices. And this might be a matter of just the generations going on, right? You have over in Europe, you'll have families of 5, 6, 7 generations. In the US, that's not as common. When you look at Europe right now and European family offices, well, first I'll say, what are your thoughts overall with the difference between the way that they behave uh, in Europe, by you, and here in the US? Do you see that difference as well?
You could get me into an awful lot of trouble here. I think that, yeah, there's a certain degree of longevity here, but that also brings a lot of intergenerational issues. We're having a really fascinating time at the moment. And as part of the result of the green work we did, you'd find a guy who'd done an industry that was no longer particularly socially acceptable, trying to find ways to make his investment program match the expectations of his grandchildren.
Mm.
You might want to call that greenwashing, or you might just say it's a sensible way of managing your grandchildren. But um, some of the really interesting conversations we're having over here, which are long duration conversations, is how do you effectively take the intention that created the wealth and turn that into intentions that create longevity and value and resilience from the future of that wealth. And that's a massive debate over here. I think it will become a much bigger debate in the US fairly quickly because the US is always much faster at picking up on smart stuff. I think European families, they are more conservative. They're very intensely private. So that trust factor is a massive benefit if you can find a way to build it. I suppose if you've had 5 generations of being pitched by every Tom, Dick, and Harry, especially every shark out there, you do get super sensitive, and I guess it's a logical consequence. But I think one of the things that's changed in the last 10 years is awareness of what you can do with your money has become much more prevalent. I'm not just talking about green stuff. I mean, it's in the old days, you buy some equities and you buy your mate's business, and that's about it. But now the range of product, the democratization of private markets, the democratization and opening up of vehicles that was simply only available to hedge funds or investment banks has meant that there's much more optionality out there. Also, a lot of wealth is now being created by financial services guys who have a supreme amount of technical capability and demand access to tools that other families might not want. So I think it's constantly evolving. I think it's nice and easy to say it's a big difference between the US and Europe. I think the structures around US families are much more advanced than they are around European families. European families traditionally had to do it all themselves. So there's been a vast amount of insourcing. And when they've outsourced, they've often been ripped off really badly. Whereas in the US, there's a much greater technical skill, there's much more access to highly technical support from people like yourselves. So I think those are key differentiators. And obviously, because now everything gets communicated, there's a good practice being transferred both directions across the Atlantic. It's not just a one
Yes.
way thing.
No, you're right. The lines of communication are opening up quite a bit more. Something I noticed just taking a client of mine on a roadshow after the Guterman event was how engaged many of the European family offices are with other small middle market family enterprises. And that's something I think you don't see a lot in the US. And granted, I mean, we're speaking in generalizations, right? You'll have very conservative families over here in the US and families that'll do more engaging, exciting things over in Europe. But I think that there was a level of sophistication amongst a lot of the European family offices that you don't see a lot, that I haven't seen a lot in the US anyways. And granted, you'll have like like the Pritzker family office over in Chicago, like they're basically an institution. They know exactly what they're doing. They have a small army working with them on their investment side. So, not speaking towards the upper echelon guys, but the majority of other families that are more, in the in-between phase, like not quite retail, not quite institution. What are your thoughts with, and this was some of the exciting stuff we discussed. Where do you see the most interesting opportunities emerging for long-term capital that family offices are engaging with?
I think one of the key things is something we're working on quite a lot with Ianua and with Suka, which is long-term planning of how the asset portfolio should take shape, how you build up a portfolio, how you operate that over time. Traditionally, I wouldn't say opportunistic. I think people have bought what was in front of them with a view that it was likely to create long-term value. And there's no doubt that in things like real estate, if you just buy it, it goes up over time.
Sure. Yes.
I don't do real estate because I just don't understand it, but
Same.
it's a thing. And, if you just bought real estate 50 years ago and it's gone up, then you've done well. But now with so much more capital, and particularly with the last, 10 years of free interest rates, people have had to diversify a lot away from just the buy and hold type strategies. And so I think you made a very good point. One thing that I do notice, particularly in Germany, and Herr Guterman is really good at this, is the localization of capital again. We've gone through a massive period. Most of my career has been about globalization and about everybody's got to invest everywhere in the world. It's great for your portfolio. But there's a new movement, which Herr Guterman is one of the pioneers of, which is this idea of bringing capital back home. In other words, investing in your backyard, encouraging businesses that are local to where you're based and giving them a leg up. Because the problem of the internationalization of capital is that you lose local favor. You lose the ability for the guy who's set up a garage just down the road from you to get capital, because how does he get capital from KKR or from Fidelity? He can't.
He doesn't. Right.
And so I think that's a really interesting trend. I think it gives you much more interesting due diligence, and it gives you the ability to put something back into the community where you live whilst you're making good money. Because access to capital is a benefit to society. It's not, lots of people think capital is evil because it's taking a tariff off people. But giving access to capital empowers innovation, it empowers businesses to grow. I think there's a problem for local businesses in accessing this huge mega pool of international capital because it's a bit amorphous.
You're so right. And that's what initially intrigued me about High Impulse and what Guterman was doing. And that the fact that it's local, of course, I like that idea. But also the fact that when I asked a lot of American investors and experts that understand new space and tech about an emerging rocket company, new space company over in Germany, they all laughed. That was their gut reaction. They didn't even know what I was talking about. And they're like, over in Germany, like, no, I mean, look over here, look at the West Coast. That's all you need to do. That's where the innovation's taking place. And I like the underdog. So that made me look at them. And then when I was impressed by them, I was like, oh man, there's really something going on here. Um, so I couldn't agree more. And I like that. I like seeing the underdog succeed, and they have their work cut out for them because of the nature of launch pads and access to, being able to carry on with their business over there. There are some challenges, there's some hurdles certainly, but yeah, I couldn't agree. I couldn't agree more. And also, when we talked about this last time, you actually understand this business quite well. Are you in your work? Have you worked with other? Because I think the name escapes me, but I think there's one or two competitors to High Impulse. I was impressed by your understanding of the rocket market, we'll say, over in Europe. You have experience in that too, Ben?
Yeah, we worked with a couple of companies. I mean, it's like you, don't tell anyone, but I also thought, if I was going to create a rocket launch business, Germany isn't where I'd start. But they've done it, and it's been driven by passion and incredible attention to practical problem solving. And
Yes.
I think that's what defines High Impulse. Yeah, they're great guys, they talk well, and they're geeky nerds, but actually, it's the way that they develop their problem solving. They don't appear to get phased by problems that have killed other businesses.
Right. So, and just to kind of close this circle here, what's something, and I work more with founders. Like when I started Arendite, it was with Series A, Series B, pre-IPO companies trying to raise money before they went public, and they would try and appeal to family offices, right? I'm in these strategic sectors. I come more from like the tech space, more broadly fintech. What would you want founders to understand about working with families that you think is missed?
I think there are a lot of problems. We do quite a lot of investor readiness training. And again, it's that listen to what they're telling you. And if it's not aligning, either solve the lack of alignment or walk away. If you walk away with dignity and you preserve someone's time, then you've always got a chance of going back. If you waste people's time, you're never going to get back in through the door, which is no good if you're a founder and you've got a passion and it's your business. But I think my problem with most founders is that they don't let go early enough. That's not the main problem, but it's the biggest problem that we're facing at the moment. You find
Mm,
the guy that sets the business up is often not the right person to run it once it starts to achieve scale. And it's a really,
yes.
really hard thing for a founder to let go. And I don't know many founders who are good at that.
Founders to let go of the reins once they've built it up.
Yeah, it doesn't
Because the
mean
same,
losing your vision. It doesn't mean losing your equity. It just means that there are better people at doing HR issues. You might be the
right,
world's greatest polypeptide developer, but that doesn't mean you're particularly good at sorting out the secretary's maternity leave. And
right,
you're probably better off delegating that to someone else and getting back in the lab where you're a genius.
right. And I've seen that take place in a couple biotech scenarios before, as I'm sure you have. And you're right. The people that are the innovators because the whole time when they started their business, before they even started generating revenue, assuming they have generated revenue, right? They've been told, why don't you go back to work? Why don't you do something else, right? So they just kept their nose down to the grindstone. And sometimes that stick to itness and grit is not going to help you manage relationships and get to the next level. That's such a great point.
I think,
Yeah, go ahead, Ben.
I think the other point which needs to be nailed onto the wall of every startup business, where are the customers? What are they buying? And why? People forget that a successful business, the only thing you need for a successful business is customers who buy the product. Everything else
Yes.
is effectively optional.
Yes. Yes, people get caught up in the culture
Yeah.
and yeah, and in once we hit this milestone, then this, and You're absolutely right. What, it's taking a step back, what values guide the way that you navigate relationships with families and or founders or financial service providers? What's your North Star?
Sound like a stuck record now. It's can you build that trust? Can you find a way to work with people? I can work with people I don't like as long as I trust and respect them. If they're creating value, if their approach is to generating value, then you can work with them. So it's about, can you build something of value with that person? Now, it's much easier if you like and respect the person. And I think without respect, mutual respect, then you're really going to struggle to get a deal done.
Are there are there principles that shape the decisions you make about who you want to work with? Because sometimes you can respect them, but their ego is just a problem. And it's like, dude, I can't help you if you don't help yourself. Like, do you have any anecdotes or hard and fast rules for how you make those choices?
No, and I think, the way that I operate is I work on the gut feel and some fairly pertinent questions. And then I surround myself with the people who are able to delve into the practical components of what are we actually getting out of this? How's it going to be structured? I think relationships make deals even now. I've still not closed a deal over Teams. In the end, face to face, is this relationship working? I am now sounding like a stuck record, even have to edit this quite heavily, but I think that that is the foundation point. You can hate Goldman Sachs, but you can still get a great deal done with them because the guys have a work ethic. You understand that work ethic. You work with it and not against it. You can get brilliant deals done with Goldman's. But you may not want to work there.
Agreed. And to that point, and no, you don't sound like a broken record, and I think it holds very much true. And it's something that does drive me nuts in this space that I've noticed from when I launched my company 3 years ago now, is all of these platforms coming out that hope to expedite the deal making process. Like we'll have capital providers here, we have sellers here, right? And it's, you jump on our platform, they take a cut, right? It kind of makes sense, but then you realize that yes, everything's becoming, more tech and quicker and more convenient. But I think it is the people that get the deals done. Like I've been pitched so many of those platforms, but I'm always, to your point, it's about the relationships. How do you motivate somebody without telling your story? I don't know, a little pet peeve of mine, but I see so many of these platforms and I haven't seen any of them have much success. But yeah,
But Seeker is a placement agent effectively. We think we're a
right.
bit more than just that. But, over the last 3 or 4 years, I've seen loads of digital deal management platforms come, and a lot of them are great. Some of them have brilliant workflow stuff. Some of them have
Yes.
great access to LPs or GPs. But the overriding failure of them is that the founder believes if he builds a platform, people will come and they'll magically transact. And the Seeker approach is, yeah, we use technology to make the whole thing much more efficient. But what that does, what the technology does, is it means that the great guys I've got working with me spend more time on the phone, more time face to face with people, because the boring stuff that takes them away from what they're good at is done by the machines. And that's where a platform creates value. So our platform, you probably never see it. It's there to facilitate the smart guys that I work with to get the buyer and the seller together and to stop having rubbish getting in the way of closing the deal.
Yes. It can expedite the due diligence and it can connect parties, but the deals still get done on the phone, and in person. And I'm not, trying to remove the significance of technology, but I'm with you there. I agree.
We
Next,
sometimes joke that getting the yes is the easy bit. My job is actually to make sure that all the stupid no's that come up between in the initial yes and final close don't kill the deal.
yes.
So deal management often is about just making sure the silly little bits that come up don't destroy it. You keep the momentum of the deal, keep the energy in the deal, and keep it moving forward. Getting someone to say yes is not as easy as it used to be, but it's still relatively easy compared to the process of taking the deal from that initial yes through to close and cash drawdown.
I love that. And I've learned too in my experience that getting to the no's, looking for no's is usually more effective than seeking for the yes. From a psychological standpoint, people feel more in control saying no than they do saying yes, right? I feel like, yeah, I've had a lot of boring conversations about just that simple dichotomy there. Something else I wanted to ask you is what have the families that you've worked with taught you about building something that lasts?
Passion overcomes an awful lot. If you know, you can be driven, but that the direction in which they're being driven takes you can be very destructive or very constructive. But passion and a deep understanding of what you're trying to achieve and what your customers want, that's the thing. If you wanted me to distill 40 years of waffling down to one single thing, it would be that.
And I love that and agreed. Um, and I got a couple more questions here because I know we're coming to the end. For founders and families listening in, what ideas would you want them to anchor themselves in as they plan for the next chapter of their life or their story, their business?
I think explore. The financial tools and the people who are capable of delivering those financial tools can do so much more for a family's portfolio now than even was possible 10 years ago, let alone when some of these families started creating wealth. And the current incumbents, the owners of those family assets, are desperate to preserve high fee level, low knowledge level amongst their
Mm,
clients. Don't be afraid to ask. Don't be afraid to push. There's so much now that technology and experts can do that you can access if you ask for it that can revolutionize the way that your portfolio performs over decades.
mm.
Yeah. If we reduce fees by 50 basis points, that accumulates. That's pure wealth going to your grandchildren. It doesn't matter whether you've allocated to gold or to mining in Timbuktu or a real estate building in Sydney. Basis points, getting properly constructed portfolios that actually encompass what you want to achieve for your children and your grandchildren. These tools are available now. It's just not being made available to you because your current supplier is able to charge you a fortune for pretty mediocre advice that they probably give to the guy who delivers Amazon to you as well.
Yes, absolutely. People do forget about kind of the fundamentals. And that I don't want to spin this off, and we might have to have a part two to this, Ben. But I'm glad you're down. I got three rapid fire questions, and then a closing question. We'll talk about where people can find you. What's a habit that keeps you grounded?
Building guitars or talking to my son,
How old is your son?
27.
Is he in finance?
Yeah, unfortunately, I spent a fortune trying to educate him so he didn't come into finance, and he's in finance and doing much better than I am.
Wow. Well,
He's
at
done,
least you did something right.
well, no, he did it all for himself. I spent 27 years trying to persuade him not to go into finance, and he has. He's absolutely knocked the ball out of the park. So,
Well, you had some role to play in that, I'm sure. Fair enough. What's one thing people misunderstand about you?
um, there's probably lots of things. I don't really want to go there. Can scrub that question.
Absolutely. What's a question you ask yourself often?
Have I really thought this through? Have I done enough to actually justify the faith we've been given in this deal?
Mm. What do you hope people understand about you after hearing this conversation?
That they can pick up the phone, they can talk about solutions to things that are bothering.
And excellent. And where can people find you, Ben? Um, where should they look for you? What what website, company? I know you're affiliated with a lot. Seeker, Aya, uh, Ianua markets. Where should people find you?
That marvelous man, Mr. Reid Hoffman, and his LinkedIn tool. That's where I'm always to be found.
That's fair. And is there anything else I should have asked you today that I haven't that you would have liked me to ask you?
One good a time. We've got another three episodes to fill.
Yeah, fair, fair. Thank you so much for joining me today, Ben. This was very enjoyable.
Thanks, Ryan. It was great fun. Take care. Have a great weekend.
Yes, you too. Take care now. That's it for this episode of Founders and Fortunes. If you want more conversations like this, subscribe on YouTube and follow the show wherever you listen to podcasts. Thank you for listening. Goodbye.